And welcome, everyone. I am Angelo Robles, and welcome to my Family Office TV Live and founder at SFO Continuity. And that will come up and be an integral part of my topic for today. So, the topic of today is investment trends of the $7 billion investor. So, I'll first begin by providing some context. So, a couple of weeks ago, I got approached, and maybe some of you will be there tomorrow. So, this is live on a Wednesday. But Thursday of this week, meeting tomorrow, I got approached by a fine gentleman in Europe named Max Pog. And he's doing an amazing digital program that's going to have a lot of participants, maybe even too much for his Zoom. And I'm one of many, many speakers, just one. I'm blending in. But I will be in kind of a block of time. I'll get 10 minutes, and I think it's three other participants, including my friend Ron Diamond. And it's going to be led that block of time by another friend of ours, Daniela Patterson. So I very, very much look forward to that. So I was calling it effectively investment trends of family offices. But Ron, my friend, is doing something relatively similar. So just a couple of days ago, I elected to kind of change the dynamic, add in the $7 billion investor. And boy, the timing couldn't be any more perfect. So for my private club of investors and family offices, it's called SFO Continuity. I hosted just yesterday morning in New York an 8 a.m. breakfast with five incredible investors. I brought up what I'll be doing today, what I'm doing on Thursday, and they gave it to me in terms of what they would do if they were in this situation, how they're investing, what they're looking at. And that led us down the road, not to steal too much from Grant Cardone himself, but 10Xing. So the question that you should always ask, whether it's doubling your money, 5X, or it seems to be because it just looks so good, 10X, what's the timeline? The timeline is 20 years. Like, who cares? Like, anyone can do that. So now some of this is proprietary for the members of my SFO Continuity, all things we'll get into, but I do enjoy to give content away for free to share with an audience, which I look forward to doing today, and in my 10 minutes of fame tomorrow, among, again, many, many quote unquote digital speakers all day. And there are one or two things I'm going to keep even close to the vest today, so I can give some unique proprietary content, even if it's just one great idea in the 10 minutes that I will have tomorrow. So if you go to my LinkedIn, you'll see various posts and reposts about that program tomorrow. You could sign up. It's free, but it may break Zoom. They have too many, so they may need to do it on YouTube Live, but you'll read the post and make your own decision. I'm somewhere early afternoon. I think the block and the group that I'm doing is something like 12 to 1 Eastern US. So, but back a little bit to the topic. So my friend Ron is going to be doing broadly investment trends. Ron is awesome. I agree with him on many things. We're both some people that are blunt and speak the truth, and it gets us in some trouble, but we also disagree. I'm a little bit more active, including myself with my holding company, believing in being a direct investor, that's how empires are built. And Ron is a little bit more of a belief is it takes too big of a team. I totally disagree with him on that. I probably should do a debate with Ron upcoming in the coming weeks. We did an interview where we mainly agreed on some broad themes a couple of months ago, and you all loved it. So I'm glad we have cross-pollination with our audiences. But Ron is probably more of an advocate of being a great LP, choosing the right fund. And I'm being way too simplistic. Watch his presentation tomorrow and watch mine. The limitations are we only get 10 minutes. But the good news is I do not get 10 minutes today. It's my StreamYard, my live, my program. So, but I don't want to be onerous and too long. So again, the topic of today, I'm titling as investment trends of the $7 billion investor. Now, some of you are thinking 7 billion is pretty random. One, it's a hell of a big number, but why not 10 or why not 5? So the Real Time Forbes 400, the so-called, and I do use that word so-called, But the so-called richest 400 people on earth, number 400, the bottom of the barrel, the last one, is worth real time about 7 billion. And yes, since COVID, those numbers with the top percentage of people that are ultra super rich, their wealth has grown rapidly. So when I ask most people what they think would be the bottom, number 400 on the Forbes 400, they usually think something between about 2 and 3 billion. Some even think 1 to 1.5 billion. It is way above that. So here's what I did in preparation, really going back about 5 or 6 days ago, and reconfirmed and added to with the breakfast meeting I hosted at the Lowe's Regency at 8 a.m. yesterday morning with 5 members, all very active investors, really incredible, and got a lot of insight. So they were all, as mentioned, very helpful. So some of the parameters were, how would you invest if seeking to be aggressive in your growth without real repercussions? That doesn't mean throw caution to the wind. It doesn't mean shoot for whatever 30 or 40x as if that's easy. And then again, like I said a little earlier, what's the timeline? So if you look at 5 years as being, I think, a reasonable timeline, doubling your money in 5 years. And by the way, what do you think is going to happen to the real-time Forbes 400? Do you think the bottom number 400 is going to stay at 7 billion 5 years from now? The odds are they're going to do above average, quote unquote, as well. So that will likely be doubled. So it's going to get harder and harder to keep up with the Joneses. Boy, I'm trying to not be too tongue-in-cheek in some of this, but some of it is a little bit that way. So what does it take to double your money in 5 years? It takes approximately about a 14.4% return. The majority of investors, inclusive of family offices and institutional investors who will tend to play it a little more conservative, is definitely not 14%. So do not, in any words or any mindset, think that that is easy. It's not. It is hard. If it was easy, everyone would be doing it. And we're going to come up with some ideas in public and private that are shared to me by the families, one of them notably bigger than $7 billion. So for one of those families that I noted, that's a pittance, so to speak. Again, trying to be a little comical because, again, I know there's people that are not necessarily in this position. So some of you may wonder why you have everything you need at that amount of money. Especially if you're the wealth creator, you have an inherent fear sometimes of what could go wrong and what could happen to you, your legacy, and your money. And what drives someone like that? What is inner in them? It's not just they need more money to buy more goods or build a bigger boat. It is a little bit of a competition with them. It's their passion. It's their obsession. Obsession, I think, is an incredible word. We tend to look down upon the word obsession in this country. That's a bad mistake. Are there bad obsessions? Of course, that take us away from our purpose. But if we're focused on our purpose that leads to our goals, obsession, if nothing else, if you're obsessed, you're a prepared mind. You got to at least admit that. So among the three, one of them was a single family office executive, but 2 of them were wealth creators. So in the world of wealth, as many of you know, at least the family office world, I'll define that a little bit as being you're a wealth creator, you're a family member or AKA inheritor, or you're a non-bloodline executive in a family office. The question then becomes, do those 3 audiences invest somewhat differently? And there's no clear-cut answer, but in my research and at heart, I consider myself a researcher of the super rich, of billionaires in family offices, having done this for near 20 years, having traveled the world and known 2,000 family offices, had liquidity events, and I'm an active allocator myself and know incredible people. Yes, there are differences. Usually, the wealth creator, and no surprise here, tends to be more aggressive and be quicker on decisions. The challenge sometimes with the non-bloodline CIO is the Warren Buffett philosophy, which I'm not saying is a bad one. Rule number 1, don't lose money. Rule number 2, remember rule number 1. Again, the mindset is going to be the family is already rich on my watch. I don't want that to change. And I don't get rewarded for potentially outperformance, or maybe I do, but not enough. And I get punished severely if things really, really go down. So by nature, most of the time, always look at incentives. The work that I do working with family offices, advising, depending on the situation, both a family member and or an executive, and issues around people and compensation is very, very important. There may also not be a moat for that non-bloodline family office executive, depending on the strategy that they utilize and what they're utilizing and investing, investment policy statement, the mandates, the risk tolerances, the liquidity, a tactical or strategic and allocations, core satellite, et cetera, et cetera, et cetera. There are some that have bordering on proprietary type strategies that give them a little extra edge with the family, depending on their relationship. A lot of any engagement in the family office, even on something somewhat quantifiable like investments, which are more easily measured, will still come down often to qualitative, how people, especially the decision maker or decision makers, feel about you. So this is no disrespect to non-bloodline executives. Some of you are incredibly talented and would like to do more things, and maybe with your own money, you could. So I would probably recommend hiring really, really high quality people, paying them incredibly well, incentivizing them to be aligned, whether that's a bonus structure, some sort of compensation, phantom stock, where they have skin in the game. And the goal is very clear if it is, quote unquote, to aggressively grow your money. So don't be a judge whether someone has a billion, 10 billion, or 100 billion, and they want a lot more. That doesn't necessarily make them greedy. It makes them talented. It makes them obsessed and focused. They are looking to procure, although you could argue they already have a legacy. Now, that's a more complicated issue with children of wealth and all that, a subject for a different time. And you don't know what their philanthropic motives are while living, helping others, or death. Do you think governments do a better job with your tax dollars? You're kidding me. They don't, if you had any wonder about that. So now that we have a little bit of a framework, but even then, like, when you look at the principles of wealth comparative to bloodline, you do have to understand, one, what is the capability of the principal? What are their goals? What's the situation on taxes, annual spend, and real inflation? So now we're getting a little interesting. The problem with being too conservative, is for a family of wealth, depending on their expenditures and other factors, inclusive of inflation. And what's true inflation for them? They're buying filet mignons. They're buying assets going up more in value. They're buying homes in expensive areas. They're traveling more. Their inflation, the government inflation is total bullshit anyway. It's especially total bullshit for them. It varies. So for some, maybe it is 5 or 6%. For others that are in this ballpark, it may very well be closer to 10 or 15%. Therefore, is getting a 6-7% return okay? Like, you're not losing principal, I guess, although it depends on what you're investing in, what year, when you look at it. But are you maintaining purchasing power for that person and the family decade after decade? You're probably not, but you're in job preservation mode, depending on your age and your career. So this becomes a complicated issue of, again, deeply incentives, of psychology, of what makes a principle of wealth that created wealth, what makes them who they are, male or female, comparative to a bloodline. Now, again, this is not going to be the core topic of today. It will not even be effectively touched on tomorrow. I only got 10 minutes. I got to get right to the good stuff then. So I think those are very, very important things to know. I will go back to the alignment of incentives. I think that's very important. And when it comes to the family office, having advised many of them, have been in the homes of principals, have smoking cigars with them, have drank scotch, have partied with them, have gotten to know them and their families, have traveled to them. Like, you get to especially if you're naturally curious and you pick up on things, you do get to pick up on certain traits and various factors. The super rich, the wealth creators, generally speaking, have an incredible ability to be calm and even thrive in the thicket of ambiguity, of uncertainty. They're usually also conscientious, meaning they're thorough and meticulous. And usually, especially a principal, more so than others, is able to usually make a quick decision. Now, sometimes principals need to be protected from themselves. Everything looks incredible, where they need a little bit of a no person, where they need someone who challenges their assumptions. I'm a believer in strong opinions, form your thesis, but have it weakly held. As new information comes in, it's okay for me to change my mind and change my opinion. Now, another topic that you always have to consider when investing is where the hell is the money coming from that I'm investing with? If I have it in effectively cash or treasuries, it's getting me 5% and it's liquid. It's a pretty good. It's not 3 or 4 years ago when I was getting near zero. So is a true benchmark, I could argue, even the S&P 500? Is it the triple Q? Notice how a lot of hedge fund managers and others, they like to pick their comparative benchmark, for lack of a better word, when it probably should be the triple Q. They often pick the S&P because it's easier for them, broadly speaking. Look at the last 5 years. They're also not telling you relative to often in terms of what levering up they're doing and risk that they're quote unquote taking. But that is a subject to a degree for, I guess you could say, a little bit of a different time. A comment from my friend Ram Alawalia in one of his recent posts on X. He noted that founding CEOs, they're effectively, his words, they're built different. He mentions Zuck of Jensen, of course, of NVIDIA. What a story that is, of Ellison. That the founder's mindset is inevitably young, regardless of age, and they're always reinventing themselves. He states that in contrast, and don't hate me, Bob, but with Bob Iger. For the most part, I think there's also founders that are miserable in terms of running a company and adapting as times go by. But for the most part, generally speaking, I agree with that comment. So do some family offices have simply an innate desire and activity with the family to be great? And yes, in my experiences traveling the world in Europe and Africa and Asia, that building an empire usually means the structuring and creation of a holding company where you own controlling interest in private companies. And I did say the word controlling and I did say private. I didn't necessarily state to start them. That's great. But look at, speaking of Zuck, what he did with Instagram, one of the greatest purchases ever. And even Elon, although Tesla was not profitable at the time, did not create Tesla. He purchased it from the two founders. So many families like to buy existing businesses that are profitable but a little dated and simply make them better. That is way easier, buying profits and enhancing them, than starting something from new. But again, a little bit of a subject of a different, or for a different time. About 7 years ago, when I was a founder and acting CEO at Family Office Association, I did an article, and the family came back to me that they liked it. It's not often you do an article or whatever, a white paper that I wrote, maybe 13, 14 pages, going back in time near 50 years ago now, of the Bass family, specifically Sid Bass, and making the decision to hire a then 26-year-old Richard Rainwater, who would go on to become an investment legend and billionaire himself. But that insight, as a family principal who's acted in their wealth, to make that decision to bring on a 26-year-old, to pluck them out of Goldman, although maybe Goldman wasn't quite the Goldman that we would know in their heyday quite back then, and for Rainwater to have the gumption to do that as well, that really other families have tried to recreate that. It's been very, very hard for them. There was one that I worked with where And again, it comes down to the most important thing is a four-letter word, and it begins with an H, by the way. It's hire. So HIRE. Hiring the right people, incentivizing them properly in terms of what's going to work for them, and having an alignment of interest is always going to be very, very important. I think our community in the family office world have, I mentioned it in a couple of my both member meetings at SFO Continuity, as well as more publicly on Family Office TV and other platforms. We've not looked at the relatively recent merger, which I think is very important to learn from, of, Trot's BDT with Michael Dell's MSD Partners. I think it's very, very interesting. So I keep an eye on broadly things that are happening both from a macro and a micro perspective, not just broadly in investing, but within the family office industry. And I do think there are dynamics happening within the community. Some will argue that are making it harder and harder for relatively smaller, AKA below several $billion single family offices to be competitive, inclusive of talent. Now, I believe, of course, that I have answers to some of that. But again, those are subjects for various member relationships and meetings and certain master classes that I'll output in the coming weeks to months to most certainly years. So again, back to a little bit of the question, how would you invest if seeking aggressive growth, kind of without repercussions? Let's broadly call it in 5 years. So we need to give it a timeline. And could you double your money? And perhaps I will share, and something that I'm doing for members this summer is, and again, stealing a little bit, I guess, from Grant Cardone, 10X. So I'm going to be doing some 10X forums, both digital and in person, and make no bones about it. We're not even close to the end of June. I've done 7 events already this year, from more social soirees to breakfast meetings like yesterday to lunches and dinners. I'm going to be active in July, and I'm damn well going to be active in August. There was a time when I exited and sold Family Office Association where I needed that break. I needed to recharge. I needed personal time and time to travel. And those days feel like 100 years ago now. I am completely in incredible shape. I am wired. I am excited. I think I'm full of knowledge, hopefully good knowledge, and a lot to share, and an active allocator in my own right. So stay tuned. But I may drop one of those ideas that even a family came up with yesterday in that before mentioned now several times breakfast meeting. I mentioned that billionaires are generally very comfortable in the thicket of ambiguity. Is that something you're born with, or is that something that could be learned? I'm going to argue it's more of the latter. Part of it's going to be your early childhood and upbringing. Was your creativity and your ability to be curious kind of punched out of you, so to speak, figuratively, of course, by parents, by teachers and others? Now, this is a deeper subject on the psychology of the super rich, another project that I'm working on, and identifying traits and the work that I do with rising generation members, both on behalf of the family, meaning more of the elders, and of the rising generation itself. So I did promise before, and we're getting pretty close, where I'm going to rattle off what others have told me, and it's probably going to be about 9 or 10 ideas to do the sort of numbers that I mentioned in terms of exponentially investing even at $7 billion. And the more capital you have, it could get harder. Just ask Warren Buffett, do you think it's easy to move the needle? He was asked by, effectively to me, a young kid at his conference from a month or so ago, kind of, I'll put my words to it a little bit, how come you're not getting 50% returns? And Warren was very cool and calm in his answer, and effectively basically stated, we're way, way, way too big. But you, young man, have the opportunity, even in the public markets, to do the research and make things happen. So no excuse why you're not doing it. Again, I've used a little bit of my words there. So again, I know I sometimes get in trouble within the community. My big issue with the community is I think it's very boring. It's very vanilla. Everyone is very politically correct and very safe. I'm not. I admit I make mistakes. I smoke cigars. I drink scotch. Like I, why are those imperfections though? Well, maybe a little bit of the smoking one. It may have bad repercussions for me long term, but I'm a libertarian. I make my own choices in terms of what I do and kind of expect you to do the same. But I think it's important that we become more creative in the community of both investing and definitely in the family office world. Things are radically changing. Look at the rise of AI and the impact on the future. Another masterclass, the future family office. And the future basically is happening now. When AI is going to be 800x more powerful in 2 years, when the current CEO of Google states it's going to be more impactful than electricity and fire, you bet you the world of AI, robotics, humanoid robotics, it's right upon us. And yes, that will make it partially into some of the ideas that myself and other families had on whether you want to call it doubling in 5 years, or if we want to get really hardcore and go for it on the 10x strategies. As I stated, whenever you're investing, you're taking money from somewhere. And if it's cash, cash is doing kind of pretty good right now. And I do go back to a little bit. Are most investors really going to beat the triple Q net of fees over time? No, they're not. And I mean the vast majority are not. Now, we're going to get to a little bit of some of that, but I seem to keep on a little bit delaying before I get to that list of whatever it is, 8, 9, or 10. In terms of, I think I mentioned a hot take, which gets me in hot water in the community. But I say it with all love. I say it with the fact that things could change. I think I could be a part of that and helping. But I say it from a reality. Too many family offices, too many are comfortable. They're not proactive. They are far from creative. Many of you have heard my little diatribe about, are you a historian or are you a revolutionary? Most are neither. You should understand both. Parts of history are very, very important in terms of as we move forward. Being an amateur philosopher and historian, I enjoy that as a bit of a sidebar for me, but you got to have some revolutionary in you as well. Now, I know this is easier for the family member, especially the creator, than it is for a non-bloodline executive that feels a level of being tied up or is comfortable not having to go out of their comfort zone and take certain risks. I absolutely feel, sadly, that too many people within life, which is why there's only a certain number of people that reach the very top. At least strive to hit the stars. You might hit the moon, as opposed to having low expectations. So rather bluntly, most people are simply too lazy. It's 9 to 5 for them. They don't want to put in the work. They think they know everything. Their ideas, they have status quo bias. They're comfortable. That's not good. I don't like that. I'm not going to work as well with those kind of people. You may be awesome. I may want to be a friend of yours. And there's things I'm sure that I could learn from you that I could learn from anyone, from everyone. They all have something they could teach me. But that is a problem, broadly speaking, with the family office world. I'm talking from the perspective of someone who knows. I'm old. I've been in it a long, long time, and I've seen it around the world. The good news is, often, shockingly, even with little or no change in personnel, going from mediocrity to good and changing those dynamics with practice management habits, some of them going back to Peter Drucker and Jim Collins, absolutely, positively work. I've seen them. I've implemented them. And there are some times when, yes, changes do need to be made. At the end of the day, the buck stops here. So in the case with the single family office, it starts and stops with the family. It's your problem if your family office isn't good, and you're also a part of it if it's great, because you create that sort of leadership and culture and bringing on the right people. Again, information is valuable only if it changes a state. The reality is most of you are status quo. So you may have incredible information. Maybe, I don't know, you go to a Tony Robbins, and I do love Tony Robbins. I've interviewed him in person actually several times. But, or you hear something from Stan Druckenmiller or someone really talented, but you listen to it, it kind of goes one ear and out the other. You don't put in the work to form your thesis, you don't take an action, and it's not changing any state. You get very comfortable in the status quo bias. If I had to recommend something, if it's too late for you, but not for your children, allow them the encourage what did you fail at today. Allow them to be creative. Allow them to make mistakes. Don't punish them for the mistakes. See what lessons they learn from it that maybe you as a mentor and or others could be of value to them. Encourage them to be a white belt in their mind, to be a lifelong learner. The opportunity, again, information is only valuable if it changes a state. So if you're receiving information, do you then double down on your idea? And why would I want to move off cash? And really the question is, why would I move off even the S&P, but in my opinion, more of the triple Q? What are you offering that is offering me more in the potential of a return? But how is it going to match the liquidity that I would have now and what I'm noting? And maybe if not the return, what more limiting risk am I getting? Knowing that if things go to hell in a handbasket, often everything kind of goes down. So I don't want to hear that in terms of being an excuse. And again, also if you're competing more as an LP, you often have limited liquidity, if not effectively none at all. You're paying 2 and 20, and you don't really exactly know what the hell is going on, at least not all the time. In other words, you have no control. So I ask you, how is your rising generation? How is your legacy? How is your prodigy going to learn if you're passive? If you're only an LP, because that's easy, you're getting lazy. That's not good. When I go around the world, when I've interviewed the Habsburgs and others, and they're talking about hundreds of years and 750 years of legacy, they roll up their sleeves and they get their hands dirty and they make mistakes. They understand how the world really works, how money is made. It's not just a passive endeavor. They are hands-on. Is it harder? Yes. So if you want the easy way out, it may work to a degree in your lifetime, but I don't think it's going to work long term. When you look at Buffett, even though he may say one thing, and you look at the 13 Fs of hedge fund managers, Bill Ackman, and I've interviewed recently Leon Cooperman, and I asked him, and because of his scale and size, being a multi-billionaire, Leon's awesome, by the way, I love him, great guy. They're concentrated, because otherwise you're just going to be average, you're going to be mediocre. So the opportunity of having 3 to 5 positions, making up probably 40 to 50% of your portfolio. But again, I know you're going to be taught to get rich, you do that, but to stay rich, you need to be more diversified. There's a grain of truth to that. So how much diversification is enough, and what stage are you growth or staying status quo? And is status quo really staying status quo? You're really kind of slowly slipping down because the world is changing and others are bypassing you. And again, a subject for a bit of a different time. Okay, so let's get on to kind of a couple of ideas. And some of them are going to be the focus of the 3 people that I did deep work in preparing for this on. A little bit of the rather brief breakfast meeting with real investor and family offices yesterday, coupled with some of my own experiences and activities in terms of what I do. So one could be, and boy, this would take a lot of work. Oh, and I forgot the lazy part. Taking a public company private and then retaking it public again. You're going to need a great investment banker. It's probably going to be as a leverage buyout, probably a tender offer with a proxy solicitation. So this person specifically said, man, Angelo, I'd love to be able to do that with Nordstrom's. Let's go through the numbers. And he's like, I think I might be able to make a run at it. His words, I could probably use a couple of others to get behind me. Like, would you approach a couple of families? Now, this was relatively recently. I need to give it consideration, understand more. But the answer is maybe. Petco would be another example. That would be a lower hanging fruit and an easier opportunity. And aspirational, he had an interesting perspective on Walgreens, which has what, a $46 billion enterprise value. So probably 25 billion, what needed to take it out. Yeah, it's a lot of money. But again, don't forget things like leverage, other people being involved, banks and others, investment bankers. It's not like you're coming up with every penny of that, quote unquote, on your own. Now, this takes big, you know what. This also makes you somewhat more public. And yes, in case you're wondering, I absolutely know real, admittingly big single family offices led often by wickedly entrepreneurial principals that are absolutely doing and willing to do something like this. Now, that could be a little of a discussion at a future point when we talk a little more, not today, but about the before mentioned BSD and BDT and MSD merger and what they might be up to. And you bet you back in the day, I'm absolutely sure Sid Bass and Richard Rainwater. And again, I just loved that combo. Great respect for both of them. And being a historian, not just broadly speaking, but of the family office community, well, that's what I do. If I have a love, if I have a passion besides family and faith, and maybe cigars, it is my obsession with the family office world and the pride I take in it. By the way, there's no such thing, and some of you have said this about me before, which is okay, you know, bring it on, so-called ego and arrogance. And I've been humbled and I've made mistakes, and I'm the first one to admit that. But like, always be humble, always be humble. It's easy for a meek person to quote unquote be humble. So the one that you should respect is the one that has the competency, the capability, perhaps to skew on the opposite side that you may call a level of arrogance, and they elect to be humble. Most people, they're just shoved into the humble box because they don't have the capacity for the opposite. Now, I have a perspective on that, on being a lion in courage, but it's considered a little politically incorrect for more of an open forum. I get in enough trouble as it is, but I did bring it up in the breakfast meeting. So you have to join my SFO continuity for a variety of different factors. We'll get to that a little bit more at the end. And we're marching towards those 30 founding members. I'm going to talk about the backgrounds of some of those members and the value, including yesterday at the breakfast meeting and through this project here, that they would bring, they are bringing to me, and they would bring to you. Even if you're worth, you know, if you're Forbes 20, you would still get value out of it. Another one is VC. Now, VC is interesting. One, could you do it in that short timeline? That makes it harder. Make no bones about it. Venture capital is an insider's game, more than other asset classes. Others will look at the statistics, including how active endowments and institutions have been, and state, ooh, look at this. It's getting greater over time than private equity, than public securities, et cetera. Not theoretically incorrect, but could be misleading. How is it doing lately? What are some of the challenges that it's going to face already moving forward? And again, I go back to the sequoias and benchmarks. They're awesome. How the hell are you going to get in there? You could be $1 billion family and come waving 20, 40, 50 million. They'll laugh at you, laugh at you. Now, are there some more nimble venture capital shops that are good? Sure. There's a lot of shit that goes on. There's a lot of things that would be illegal in the public markets that are, I guess, completely legal in the venture capital market. Having been to Silicon Valley a gazillion times and having interviewed people like Mike Moritz at Sequoia, Peter Thiel, Naval Ravikant, it's an interesting industry with a level of star making by the people in the know and power there. Now, you becoming a one-off investor in earlier opportunities, well then, like, why was it bypassed by whatever, Silicon Valley, Boston, Austin, other areas, Israel, etc., where earlier stage investing is more common? Do the so-called professionals make mistakes? You bet you. And I'm going to give you an example of one without giving much context to it that again, and that person's a member actually, that will be saved for a digital and in person for those that are a part of my membership group. So I don't think in relatively a short window that VC, although 14.4% to double in 5 years sounds reasonable, but again, you're going to be structured within an LP, and the current state of VC and moving forward, I think there could be, and the fact that you're not getting into the best of the best makes it challenging. In certain sectors of GPLP, size and scale means you're bloated, you're an asset manager, you don't give a damn about alpha, and you're placating to boring institutions. But in the world of VC, to some level, the connectivity, the power, and the scale can matter. So that is kind of one of the exceptions. How about this? I kind of hinted at it earlier. Why don't you just invest in the triple Q and go to sleep? Now, again, what's your macro and your micro? What's your geopolitical? What's going to happen with the elections this year? What's going to be the impact on inflation and interest rates? All these things interplay, and you should have knowledge and enough fluidity on them. But you start getting too many inputs. Listen to my interviews with Adam Robinson over the years, and he'll tell you, you want to limit, at least initially, your screening of a limited number of inputs and make your decision perhaps after some level of one or two additional from there. But once you start getting a million different things coming in, I don't know if you're necessarily, quote unquote, making better decisions. I will already tell you, you're probably going to be better off. Now, the challenge is going to be some of you are going to look at it as a CIO and say, Angelo, that's boring. That doesn't give me an edge. Families are going to look at it and say, I'm not going to overpay for this CIO if they're doing the strategy that is working. That is working. That gives you liquidity. You know exactly what's going on. If you're large enough and you could effectively buy the triple Q, the individual companies on your own, so you have an opportunity for tax loss harvesting for your own level of concentration. Sometimes the simple answer, even for people worth billions and billions, is the correct one. Speaking of that, do you look at some of the Magnificent Seven and others, but like an NVIDIA, a Meta, and a Microsoft, and you're looking to move billions of dollars? Those are gigantic companies. You certainly could. Oh, you could get a little cute and do block trades in a dark pool, try to be a little off the grid and off the radar. But are you telling me that NVIDIA, that Meta and Microsoft is at least potentially not going to double in 5 years with what's going on in big tech and AI? And I don't want to fight that thesis. Now, again, I don't know. World war, things could happen. There's always risk. And by the way, the old families going back 750 plus years old, they like land, they like art, they like gems, and they like gold. And I'm a believer in those asset classes for a percentage of the portfolio for a variety of reasons, including hedging and geopolitical risk. And other stock that someone brought up that thinks actually way better likelihood of way more than doubling in 5 years. This might be one of the 10x ones, and that would be Lilly, meaning the pharmaceutical company. So again, going back to what Warren Buffett said to the kid earlier, there are absolutely opportunities in the market. And I'm naming a little bit of kind of no-brainers over a 5-year period that could. I said could, I have no idea, but could do very well. With some of them, could any one of those that I mentioned 10x? And again, it's all about the timeline. I mean, that's a bit of a stretch. I can't say that's historically going to happen. But could they? Yes, of course they could. How about we think a little downstream from AI, NVIDIA? What are they all going to need? Energy. Now, I could talk a little bit about oil and gas. I could go get my 10-gallon, which I legitimately have. Many of you have seen me with it. Stetson cowboy hat. I love Wyoming. I love Texas too. So how about more of a public play? Constellation Energy, CEG. Nuclear, but We're not building new nuclear here. We should be. Canada's, shockingly, a little better at that. And look at France and certain other countries. But look at what Sam Altman did with that SPAC that was going to be in nuclear. Like, I'm going to start to due diligence and doing work on that because I think energy plays, traditional oil and gas, we're going to get to another soon. Nuclear plays are absolutely ones that you should be active in looking at. Roll up your sleeves, stop being lazy, put in the work, have the capacity, or damn it, let me talk to your principal to have the capacity for you to take certain so-called risk. How I often hedge certain risks with me, well, it's not really much of a new idea here. I limit my exposure. You all said I was crazy when I was talking a lot about crypto in 2020 and 21. I looked really good then. I looked really bad in 2022. Depending on what you did, I looked pretty damn good both last year and most definitely this year. And certain investments have went up 30, 50, over 100x. Now, we're going to get to maybe just a pinch of that, although that's going to be a little bit more on the more exponential kind of 10x ideas that is really going to be more focused on my members, both digitally and in person. But let's go a little bit back to the before mentioned brilliant and watch my interview with him, Ram Alawalia, who will join us at some member meetings for in-person interaction and real grilling on a whole bunch of investment ideas and themes. So he noted, follow the money. Who's going to power, or what's going to power the utilities, the data centers, the power of the clouds and apps? And he mentions liquid natural gas. Does that, his words, Mr. Market, hasn't caught up with that yet. But LNG is a transitional fuel. Oil and coal won't power ESG hyperscalers. He states renewables need multiple more years. I could argue that I think the powers that be probably would prefer nuclear. That's going to be a better play, but how you're going to do that as an investor is a little bit more complex. But the right question to really ask is kind of what I hinted earlier. Instead of asking, will liquid natural gas, the right question is, will liquid natural gas outperform the S&P and really the triple Q? If you don't feel as such and you don't feel you're getting risk mitigation, then why? I'm getting 5% in cash. I'm getting on average this, quote unquote, with the triple Q. So these are all considerations that you need to consider as an investor. There's a deeper dive into liquid natural gas. Some of it is great and opportunistic. Some of it actually is a little challenging. So sometimes the grass isn't always greener. Sometimes it is a little complicated, which is why you need to get the right information to form a thesis and make a decision. And certain things in today's world do need to be tactical. Not everything is going to take forever and be a long, long hold. Another subject that we could talk about for a long, long time. Another one, I guess, number 5 or 6. When I mentioned it indirectly a little before, although it's the big blue of crypto and Web3, and that would be Bitcoin. About a $1.3 trillion market cap now? You don't see a future doubling, AKA 14 or so percent over 5 years to have that double? Yeah, that, I don't know, maybe not. Maybe that might be one of the ones, although I think a little more unlikely in terms of to 10x in that sort of time. But that could be a very good play as well. And again, if you deem as such and want to still do it, but limit your exposure, limit your allocation. You probably have a lot of shit doing crap now anyway. Reposition to 1 or 2% of your portfolio into something like that. Now, again, you could get overly diversified. You're not taking concentrated bets. You're not really going to quote unquote outperform. So therefore, if you have that in you, I want to go from number 400 of the Forbes 400. I know my others are going to be tough competitors. How do I move up that rank to, and I'm being, again, now a little tongue-in-cheek, but there are people that think that way. That's their process thinking. That's their obsession. And that's what makes them tick. Let them do their thing. Many of them are doing many good things for the economy. They're paying their taxes, and the whole garbage about how the super rich don't pay their taxes. Look at the facts. They pay the vast majority of the taxes, and yet we're making all sorts of bad decisions in the West relative to that. But I do digress a little bit. Okay, one that's going to surprise some of you a little bit. Now might be the time, might be a pinch early. CRE, commercial real estate. And an extra shocker, maybe San Francisco. Now, is real estate very local and geographic? Yes. Does it take a level potentially of really being in the know? Do people in the know, including politically, are they the ones that may get first dibs? Is it going to be the availability for liquidity and cash, dry powder to move quickly? But if you're getting, and Lord knows, with over levered and higher interest rates, there's a lot of turning in the keys, and these banks and others, insurance companies, whatever, don't want to hold on to these assets. I mean, they probably should, but they have other cash liquidity needs. This is an absolute opportunity in select CRE and select geographies, and maybe one of them is San Francisco. Now, I know what many of you are saying. San Francisco had parts of it that were incredibly beautiful, very intellectual, very creative, European-like architecture, but man, it went to hell in a handbasket lately. Yup, you are correct, but is it going to stay that way forever? Is the price low enough now? Is there the inkling of political and other changes happening there that, depending on a variety of local, national, and international factors, that could be a play that could pay out very, very well? I damn well know that I have families that think as such, and maybe you feel that way too. A little bit more boring, but I mentioned before the holding companies and looking at a various sector. I've looked at RV parks, mobile home parks. I'm fascinated by ranch land. That's a little harder and would take more capital. But yes, those are also sectors and industries that you could develop a niche in that could be valuable from a direct ownership perspective, and absolutely the opportunity of doubling the money. And again, it all comes down to the timeline, and really 5 years, 14.4%. Come on, you all can do that. I have a couple of more to go. I'm going to just note again, this is at this point in time in June of 2024. You may see this at a different time. And again, what did I say? Strong thesis, but weakly held, because conditions change and new opportunities arise. So this is applicable at this point in time. But this is a value of joining my SFO continuity, of going to angelorobles.com and wanting to be one of my 30 founding members. I'm going to give you the profile in about 10 more minutes as I wrap up in terms of some of the members, and they are incredible. I have amazing wealth creators, one or two family members, one or two or a couple of more executives. And what we're talking about in all these meetings that I'm hosting, which originally might have been thoughtful as being digital masterclasses, digital forums, and my work in best practices. And man, I really realized you all love in person, and that's awesome, which is why I've done 7 events so far in June, why I'm going to be wickedly active for the remainder of the summer, while I'm going to be very active in Palm Beach and partially Miami in the winter, and LA, I didn't forget about you, and of course, my beloved Jackson Hole, Wyoming. So that is all upcoming. A little bit more about that to the end. We are marching and getting closer to the 30. If you're qualified as an investor, a family, or a single family office, would love for you to go to angelorobles.com, look at SFO continuity, aka membership, and join. So again, a little bit more on that coming up. And yes, I can't go too far without a cigar, which happens to be right here, everyone. I have lit up before. on screen my interview with legendary Swiss economist Mark Faber. It was like midnight his time, just a brief story, then we'll get back to it. And it smells great, but I'm not going to light up. But I may hold it because I just need to. So he starts to drink a beer. I'm not making this up. You could go watch it on my @FamilyOffice on YouTube. I think it was 2 springs ago. And I've interviewed Mark a couple of times. I think he's awesome, by the way. And he starts to smoke a cigarette like, Mark, you're going to get me going. So I reached out, got one of my cigars. I took out my flamethrower. I had a Woodford Reserve whiskey. I poured myself a shot. And we had a great 2 hours of great content. So maybe I work a little better with cigars and liquor. There are some questions coming in. Normally, I'm pretty good with being reactive near at the moment. Sorry that I haven't responded. I am going to look at those questions now and then head to the final 10 minutes of what I'm talking about. Some of you are just, thank you, by the way. Some, I have a nice tie on. You're enjoying the cigar. It'd be real if I could light it up. I should have the guts to do that again, but it's going to make my house smell. So I'm going to go outside and enjoy this. How about I change off into my suit and enjoy the cigar in full after this? So some of the questions: with equities at all-time highs, how are family offices currently looking at their alternatives in real estate allocations? Yes, equities are at all-time highs. I know what the hell I own. I'm completely liquid. What's to say they're not going to get higher? Parts of the Magnificent Seven are doing incredible. What Tesla is going to be doing in a variety of different things, including what Elon's doing with humanoid robots in his work, although it's different in XAI, but how that could integrate into Tesla. And some of the opportunities that I still see out there. I'm not going to placate to the alternative investment industry, even though I'm partially based in Greenwich. There's some of the smartest people that I know, some great people, and some friends of mine. The 2 and 20 model, to some degree, could be broke. Are you really outperforming even the triple Q net of taxes? Well, that too, but yeah, but net of fees primarily. So these are all questions that need to be asked. You could argue, has the government kept interest rates artificially low that suppressed hedge fund managers for a number of years, and now things appear to be a little bit more fair, so-called, or freewheeling? So I think, what a surprise here. There's a small percentage, maybe it's 5 or 10% of alternative managers that could be a good fit. What I'm saying is, family offices, you got to get up off your butt a little bit more and be more proactive in these decisions in investing and what's going to be your game plan. Now, to take a little bit of the opposite approach to that, I think it's up on my homepage as a video. You can scroll down or go to my Family Office TV on YouTube or @FamilyOffice on YouTube. In February, I did an interview with Donatella Ceccarelli. I met her when I was in Austria. She's an Italian. I love that. So I interviewed her. Man, she's incredible. CIO of a family office, a monster one in Central Europe. And at peak, which wasn't that long ago, she was an LP allocator to over 100 different funds and gave me a good run for the money as to why she was right, I was wrong. I mean, we kind of agree that it's complicated and it depends on the family. And the answer maybe could be a little bit in the middle. When it comes to your real estate part of the question, I kind of hinted at that in the CRE. There might be some time now. Everyone is doing storage, so is that getting overplayed? And perhaps the real people that move in silence, the real rulers of quote unquote the world that want to be below the radar, they're looking where you're not looking, and that might be other forms of commercial real estate. Stacy asked, will Trump's victory affect energy investments? Will post-election be too late to invest? No, to the latter. And yeah, I mean, I guess Trump could have an impact, obviously, on energy. I could tell you what I'm doing and other family offices are doing. We are absolutely looking at energy. I love clean energy. I think there's opportunities there. I really love nuclear energy, and I want that. Do I think the future long-term is going to be clean energy and I want to be a part of it? Of course. But am I going to ignore The fact for my own country's safety and security that we have massive oil and gas reserves, I'm going to ignore that? No, I think we need to drill. I think we need to hedge and protect our own risk. I think we need the energy, and I think there's opportunities out there. Now, again, I didn't say I was the nicest or friendliest guy in the world. I'm not the most politically correct. I'm just telling you, and again, I'm looking for 30 founding members among 9 billion people. And then maybe we grow slowly after that. I do a couple of consulting assignments a year, including, by the way, to legal, accounting, financial services, MFOs, and RIAs, understanding mindset and traits of super rich billionaires and family offices, and helping them from becoming effectively more successful. I don't need a lot of relationships. I don't care about scale. I don't care about hundreds and hundreds, let alone thousands. How about a couple of dozen people that love me and feel that me and my group provide value, and we tell it like we see it, and you could tell that back to me. You should hear some of the discussions, including on social issues, on a variety of factors that I've had with my members. Please follow up with me, Angelo Robles, but I don't know who you are at the States LinkedIn loser. I'm getting a little tired. User, my apologies. So you have to DM me on LinkedIn is fine. So you need to be a little proactive and let me know exactly what you need there. Okay, so as we're heading to the home stretch, how about mining asteroids for precious metals? Now, is that a 5-year play? Absolutely not. Is that a massive exponential play long term? It could be. I mean, I'm going to try to see what Elon's up to on that. And by the way, in case you're wondering, that man's family office, I always said you could tell by going into a family office or getting to know them, and I'm not saying yes or no, whether they're great. They're usually rigorous, ruthless, in a good way, ruthless and fast. There are some people that have incredible family offices, and they pay them unbelievably well, and they produce. I believe in the world of investing in family offices. I believe in a complete meritocracy. It strictly is based on merit. I don't give, do I have to be politically correct? I don't give a you-know-what about your tenure. I don't care about being egalitarian, did I pronounce that right? All I care about are results. Results compared to a benchmark that I have and or others that you may be competing against. This is a competitive business. Let's not try to sugarcoat it and be all nice. Oh, it's all only about wealth preservation. Without growth, what are you doing, like I said earlier, about protecting purchasing power? What lessons are you teaching the rising generation? How engaged are they? I mean, come on, like stop the cap. Just for those of you a little older that don't know what that is, like stop the lie that you may be even telling yourself. Sports teams. I have a couple of relationships that are active in the world of sports teams. One that I saw last week at a rooftop soiree that I hosted in New York. I have one that is effectively the lead and seed investor into the fast rising sport of pickleball. I think that's going to be very intriguing moving forward. And man, I don't want to open up a can of worms here, and I'll probably keep this just about a minute. I think there could be, I said could be, tremendous opportunity in the world of female sports. I do look at the WNBA. I look at what's giving it attention now. I look at the revenues. I look at what the team's estimated values are. I scratch my head after 27 years why they lose money every year, and they're losing a truckload of money this year. Something's wrong there with the level of the commissioner and leadership. But maybe some things take time. But I think there's opportunity there. I had one of my family members that outlined a thesis and plan that was probably like 7 or 8 pages thick as an outline of what they would do with certain franchises. And actually, in one of my states here in Connecticut, we have the Connecticut Sun. They don't have competition from another major professional sports league or a male counterpart in basketball. You could argue the Boston Celtics are relatively close. They have the casinos. So, what would you do to have an interest in a sports team where you control some of the surrounding 20, 30, 40 acres, some of the opportunities for hotels, lodging, family entertainment, etc.? I think there's an opportunity there to kind of create a little bit of a monopoly, because that's effectively what sports teams are. You look at the NFL, the MLB, the NHL, the NBA, there's a finite number of them. Everything comes down to supply and demand within a given market infrastructure. There is way, way more demand to people who want in than there is available supply. And that supply is going to be very, very limited. That's what makes it, quote unquote, intriguing. You need to form a thesis. It needs to be well thought out. And this may take some rolling up the sleeves, some gumption. You don't think younger family members would be interested in a subset of the family's interest and allocations going in, even if it's a non-controlling interest, into sports? And you look at the track records over time, they're pretty attractive. Now, again, this may be one where the 5-year time horizon may be a little bit more limiting. I mean, I could go on about AI and robotics. I think Elon stated humanoid robotics will be a $24 trillion opportunity. Think of the industries that will upend. I would think of healthcare, manufacturing, to some degree construction, and education. Every one of those industries that I noted, and these are the conversations we have in my private club, are multiple trillion-dollar opportunities or sectors, market caps. They are being upended at the moment. Look at the work that Beyond Imagination is doing on humanoid robotics. Look at Elon's company that he's doing on that, and look at others. This is Boston Dynamics, etc. All of this is happening rapidly, rapidly. These are absolutely going to be opportunities, including in some of the Magnificent Seven, keeping it public, or other companies that play in that space that are quote unquote public companies. And you bet you, if we look at the 10 largest companies by market cap and 20 largest companies by market cap, you don't think within 5 years and definitely 10 years that will be different? Companies we never quite heard of. Who would have saw NVIDIA coming just a couple of years ago? What's going to happen in areas in healthcare, in longevity, in biotech? What impact is AI going to make of that? Think about these things. There are a lot of opportunities out there. Let's hope the world doesn't just blow up, that we just don't go to all-out war and things go to hell in a handbasket so much where then none of this is really going to matter anymore. But this is an opportunity for you to make an impact from a societal perspective and from your own perspective. If you want to call it greed, call it greed. There are opportunities that are out there. You have to put in the time, you have to put in the work, and you need to have the capability of taking some risk that, again, you're limiting, I could argue, by the allocations that you make. But then you're going to bitch and moan if it goes up 5 or 10x that you didn't have more money in. That's the trade-off that you have made. Well, this has gone a bit longer. No surprise for me than I expected. A reminder, I'm having an awesome summer. I'm incredibly busy. We're now effectively about mid-June of 2024. If you're watching this at a future point, those of you that are live tomorrow on Max Pogs, and if you go to my LinkedIn, you'll see some repost I did. You could sign up for that. I'm going to have my 10 minutes of fame, whatever, 1,000 plus YouTube and video live subscribers. I'll try to drop something that would be different in the dynamic than what I mentioned today. So you still want to listen to it. And yes, I did mention I'm completely fascinated by the world of investing. I look at opportunities that could be exponential. I do look at things that what could I 10x? And again, the question becomes timeline, because that really is what will matter. If I look at what could within 5 years, given that as a benchmark, these are things that this summer, no waiting until me going traveling anywhere, baloney. This summer, already did it yesterday in mid-June at my breakfast meeting for my members. We'll be doing it digitally. So convenience, I have members in Europe. You could be anywhere in the world, and absolutely in person. Again, New York is primarily a hub in the spring and summer, early fall. Palm Beach is primarily a hub late fall into winter, early spring. But I got to do one thing in Jackson Hole, a little bit maybe in Greenwich and the Hamptons. And I do got to show Southern California some love as well, whether LA and San Diego. So no matter where you are, one, you're going to want to come in and meet the incredible fellow quote unquote members, but the opportunity of some things that will digitally record and other things that we're doing that are more digital from the initial perspective. And yes, that is going to be one of the things probably once a quarter we'll do. Let's get together, including this summer, what's going to 10x in 5 years. No guarantees. The odds are, I guess it probably won't. But what's your thesis as to why? And could you take a grilling? Could you take people going at you really, really hard? There are definitely is going to be a play within crypto / Web3 that is going to be a great, great opportunity. I may drop one of them tomorrow. I'm not going to mention it now. If you're a member, you could reach out to me and call me anytime. I'm happy to do that Zoom and have that conversation. And also, let's save some of this for the 10X forums for family offices, my members, that I am going to host. And by the way, I do think that things like Dell, Apple, Lilly, NVIDIA could all be things that do this. And I know you're going to say, well, those market caps will be crazy. Look at 10 years ago, look at 20 years ago, but look at the change that AI is causing now, similarly to how a couple of decades ago that the internet had. So I did promise I would also give a little bit of context in terms of how you could be a greater part of what I do. I love Family Office TV. I love to share. I do enjoy a little bit of the stage of it, I guess you could say. And I do want to give back my knowledge and what I know. So I'm glad to reach a more global audience than I ever have before. And I learn from so many of you, and I greatly appreciate you. I still love the work that I do. I do own Family Office Masterclass. So being an educator on the nuances of an opaque industry like the family office world, and sharing my experience over decades, being an entrepreneur, having liquidity, knowing thousands of family offices, and advising to multiple of them, including some truly significant. I've learned so much, and I do love to share that. So my members get that automatically, but there is some one-off opportunities at angelorobles.com as I make certain updates or masterclasses available for a fee to be able to download them. But a true passion, besides my private consulting work with both advisors, and I do that as well as directly with families and family offices on creation or the restructuring. And if I had to list my one true love, and you're going to think it's boring as hell, I would love to be reborn as the next Peter Drucker. So I love Peter Drucker and Jim Collins' practice management in a single family office. Boy, I'm a narrow son of a gun. That is my true love. There's usually 2 or 3 assignments on a consultative basis that I take on. My members get some lighter things relative to that. But the true one-on-one and with you for days or a week and then some follow-up, that's my passion. But I did state I would get back to SFO continuity. So simply go to my website, my name, angelorobles.com. Go to the membership tab, and it's or SFO continuity, and you'll get a couple of paragraphs what it is. It's my private club dedicated to families and single family offices, maybe If you're a partner CIO in a very old school MFO, I'd consider it, but I am not looking in that. I don't want vendors. I don't want sponsors. Thought leaders, I may invite you to one of the breakfast meetings where we could grill the hell out of you. One of my members wanted to invite a manager or two that he was looking at where other members could grill them. I love that idea, but I don't want from that perspective money from vendors or sponsors. You as a family or SFO are paying to be a member, and you're getting the value of my experiences over decades in the single family office community, my knowledge on best practices and investing, the fact that I have structures in Wyoming, and I'm even building an unregulated private trust company myself for my legacy and the things that I'm doing. I am eating my cooking, and actually, literally and figuratively, my cooking is actually pretty good. So the real value, as much as I think those are incredible, is who else is in the group and who are you going to get to know both digitally and, more importantly, in person. And make no bones about it, I am extremely active in person. In June, kind of the summer, I've already done 7 events. I'm doing some in July, and I mean in person, at least one, if not more, in August. And then September, we really get at it. So New York, Palm Beach, I mentioned Jackson Hole, upcoming LA, maybe a little bit of Austria, which I do love. Shout out to my friends there. And of course, Greenwich and the Hamptons and Miami. So we are active. But most important is I'm looking for 30 founders to make an impact. Founders that are real as families and SFOs, that have something to bring to the table and offer, that are going to be collectively an amazing member and part of the group, that want to be part of something intimate, that want to get in early and get more favorable access and an opportunity to shape our direction and our growth. And of course, money does matter. You're getting in at a price that, assuming we open up to others after 30, they will not be a founder charter. They'll be a member and they'll be awesome and we'll love them, but they'll pay more money. So there is an incentive, for lack of a better word, besides the fact that you get the insight and the opportunities to interact right now, and I'm wickedly busy this summer of 2024, you get the opportunity to help shape the direction and you get a better price. So let me give you some of the context, whether it was people that were at the breakfast meeting yesterday and or others that have joined, and we're marching towards that 30. We're well above half of that, well above. So there's kind of a couple of more spots, and I absolutely would hope to fill them by this summer, especially since I've been so active and putting so much output and content for my members that are out there. And again, I want in that, like, no vendors, no sponsors. I'm not looking to build what I built at FOA. I'm not looking to build an organ. And yeah, that was great and that was profitable. I've been there. I've done that. I'm looking for something else that allows intimacy, that allows something bespoke that I want to be a part of and I'm learning from and I'm being additive to, given my experiences and my activities specifically as an investor. So members include someone who is a founder of the Harvard Management Company back in '74. You don't think that person knows a thing or two about alternatives and has seen everything and knows everyone, and that person's active? How about someone who is likely the best crypto Web3 investor that I know and came from nothing? How about someone who's invested over decades in 900 private companies? How about someone who was an early adapter as an investor in family office decades ago in alternatives and understands GP and LP and where you could get screwed, what to look out for, etc.? How about another that is a multi-time tech entrepreneur that had incredible liquidity events and is very well connected to the in the know crowd, for lack of a better word, in Silicon Valley and beyond? How about someone who had an investment that was 7 figures going in and 300x return? You heard that right. You're going to do the math on that and say, man, that person recently made a hell of a lot of money and is a wonderful man, didn't just get lucky, met the founder through networking and co-investing in another company. That's how this happens. You need to be a part of it. You need to join. You need to meet incredible people. I could go on and on. One of my European families that's an amazing entrepreneur and has massive deal flow in what he's doing in Europe, specifically in Central Europe. I have another that's an incredible philanthropist, and his total goal is to give back. You want me to name more? I'll have another that is the head non-family member, head of a family office of a gigantic international, for many years, iconic family, single family office. And that man's knowledge on practice management and running an effective family office, you're going to tell me that you paying a couple of $1,000s to be a founding member, that you're not going to get value out of, if you get one thing of value, one connection, one idea, it's worth it. If you're going to be, and no one could do everything, but if you're going to be active in a third of what I do, from digital to intellectual content to connectivity with me and with peers, even just 2 or 3 times a year, and have me introduce you to these people, to have face-to-face, this is incredible. Yeah, I'm passionate about what I do. Yes, I could be a little over the top. This is my love. This is my obsession. Did I always like the way things wrapped up a couple of years ago? No, I've been humbled. I would have done things differently. I've been there. I've done that. I've spoken about that. I am really, really excited about where I am and what I'm doing. I do have competency, because confidence is a little bit fake because it can't be measured. I think your competency could. This is my life, specifically, very specific, the single family office. So I do recommend you go to angelorobles.com. I do recommend, if qualified, that you join, like today, and be a part of SFO Continuity, my membership organization. And don't think for a second I'm going to let you rest and relax this summer. You are going to be damn busy. We are going to go at it. It's going to be a lot of fun. And if you're not qualified as a family or SFO, I still love you. I'm sure you're still awesome. I got my Family Office TV. My masterclasses for a fee are still available. And bring it on. You may want to be someone that I would be a good consultative relationship with, that I think it could be mutually beneficial. Now, I don't have a lot of capacity for that. I'm very high energy. I am kind of 7 days a week. And boy, are my batteries all recharged. So that's not the issue. There's only 24 hours in a day, and can I at least have 4 to 5 hours of sleep? And a little bit of time to go to Wyoming, to ride horses, to apparently to smoke cigars, to have some good scotch, great food, be around family, and be around great people. So on that note, I'm going to take a final look for questions. Thank you so much, Stacy. That's very kind of you. I've enjoyed your LinkedIn profile and your post and your comments. That's very, very kind. And yes, I am open-minded to the right MFOs, where if you tell me, Angelo, I'm successful, I'm a founding partner, I'm a real active investor and allocator, and we have families concerned about this and legacy issues, and I want to be additive to a group. That's a little more case by case than it is directly for an ultra high net worth individual or single family office. But there are some of you that are damn good and really, really sharp and great investors, where it would be incredibly additive to an organization like mine. And again, how long the founding, AKA charter opportunity is going to be available? Hopefully not much longer, but it is the summer, so who knows? And even if it is after that fact, I'm not going to triple the price, but it is going to go up. And there's certainly a stature and an immediate benefit this summer, just that 10x form alone. And again, I can't give that away on a public thing. It's unfair to those that pay and subscribe. If anything, I give away too much as it is already. So a lot of the real stuff, the stuff that is turbocharged, I do need to save for the members. And again, a lot of it isn't even me. It simply is your peers, whether digitally or especially in person, that's going to be in front of you and to your left and to your right. So everyone, I hope I was going to say having a great summer, but technically we're a day away from that. So it's technically the late spring in the greater lower New England, New York area. I'm not in Wyoming or traveling at the moment. We are going to hit a 90 plus today. I kind of like the hot weather, so I don't know if I like a suit and tie in it, but that's why I'm going to change. I'm going to take a dive in the pool, then go to smoke my cigar. And then I got a master class that I'm working on that's really exciting that I need to focus on. And then I have a whole bunch of upcoming soirees, investor lunches, in-person dinners, forums. So I'm busy. The rest is over. It's time to get things done. Thank you all for your time. Follow me on LinkedIn. Follow me on YouTube. I'm at Family Office is my larger channel, but my more modern one, more focused really is Family Office, or on Family Offices, is Family Office TV. I'm moderately active on X, so do follow me on the platforms. Feel free to DM me. I always appreciate that, and I 99% of the time respond to everyone quickly. I don't even care if you text me, 203-570-2898. If anything, I encourage it. I want you to reach out. I want to learn from all of you. And of course, go to angelorobles.com, interact with me there, or email me at angelo@angelorobles.com. But yes, now is the time to go to angelorobles.com and join my membership at SFO Continuity. I'll instantly reach out to you. We'll schedule our one-on-one time, and then you'll just jump right into the thicket, the word that I used earlier, as the super rich and successful are comfortable in the thicket of ambiguity. We try to take away some of that ambiguity by having more certainty than uncertainty, but we're in an uncertain world, and we just don't know. But having incredible, anti-fragile other people around you and learning is how we get it done. Enough. Enjoy your day, everyone. You all know how to reach out. Look forward to next time. Thank you.